Welcome back to the Deep Dive. It is Monday, February 16th, 2026.
And if you're listening in the US, you might be enjoying a bit of a quiet day.
That's right. It's President's Day. The New York Stock Exchange is closed. The trading floor is completely empty.
But if you think that means the financial world has actually, stopped spinning for the day.
You are very, very mistaken.
In fact, I'd argue the machinery is probably grinding even harder today than it was on Friday.
How so?
Well, while New York sleeps, the rest of the globe is moving. And honestly, that silence in the US markets, it feels deceptive.
Yeah, deceptive is a good word. It feels like the calm before a very specific kind of storm.
It feels heavy.
It does. And the timing here is just, it's incredible. We are standing right on the precipice of a massive shift in the calendar.
Right. Tomorrow, it formally begins. The Lunar New Year.
We are leaving the year of the snake behind. We are entering the year of the fire horse.
The fire horse. You really couldn't pick a better mascot for the data sitting on our desk today, could you?
It sounds so dramatic, though, like a movie title or something. What does it actually represent in a market context?
Well, in the zodiac, the fire horse only comes around once every 60 years. It represents extreme energy, speed, and this is the crucial part, volatility.
Disruption.
Total disruption.
Yeah.
And if you look at the reports we've pulled for this deep dive, from Goldman Sachs, from UBS, from the geopolitical summits happening in India as we speak, volatility isn't just some horoscope prediction.
No.
It is the defining operating principle for the entire global economy this quarter.
Energy and speed. That's really been the mantra of the last 3 years, hasn't it? The whole AI boom.
Oh, absolutely.
We've been in this breathless sprint since 2023 where investors they just threw money at anything with a microchip and watched it double.
It felt easy.
It felt inevitable.
It was the classic rising tide lifts all boats era. But looking at the numbers this morning, I think it's pretty safe to say that era officially ended on Friday. The map has changed.
And that is our mission for this hour. We're going to stop running for a second and actually look at this new map. Because the old narrative that AI is great for everyone, that's dead. The market is fractured.
It really is. It's cracking right down the middle.
It's not a subtle crack either.
No, we are seeing a violent separation. On one side, you have what the big institutional players are calling AI-resistant companies. These are the new fortresses.
And on the other side.
The AI exposed. The companies that are, frankly, walking straight into a buzzsaw.
So by the end of this deep dive, we're going to break down a very specific institutional strategy called the pair trade.
Yeah, this is what the big desks are using right now.
We're going to show you how banks like Goldman are using it to filter their portfolios, and more importantly, how you can apply that same logic to your own holdings. Because if you are still investing like it's 2024,
you are about to get run over by the fire horse.
The rules of the game have definitely changed.
No question.
So let's start with the mood, the macro mood. It's February 2026. In the background, we've got the U.S. government in a partial shutdown. Again.
The third one of Trump's second term. And, it just adds this layer of friction to everything.
Right.
Homeland Security is impacted. You're seeing TSA lines slow down. The core funding runs through September, so it's not a catastrophe, but it's noise.
It's annoying noise that just sets this tone of dysfunction.
Exactly. But on Wall Street, there's a heavier cloud, something we're calling the wall of worry.
Yeah. Despite all the tech rallies of the past, there is this palpable anxiety right now. What is actually spooking the smart money? Because usually tech loves a future-focused story.
It really boils down to two massive fears, and both of them are destroying visibility.
Okay.
See, investors can handle bad news. What they cannot handle is uncertainty. And right now, we have two different flavors of it. The first one is universal disruption.
This is the idea that AI just changes everything, everywhere, all at once.
Percy cement. If you're a value investor, your job is to look at a company's cash flows for the next 10 years. You model it all out.
Sure.
But what if AI radically reshapes the entire economy in, say, 3 years? If it changes how we work, how we consume, how we live, how on earth do you value a 10-year cash flow?
You can't.
You can't. The traditional valuation models are literally breaking down because the inputs are unstable.
Okay, so that's the big philosophical fear. What's the second one?
The second fear is much more immediate, and honestly, it's more mathematically terrifying. It's the CapEx black hole.
CapEx, right. Capital expenditure. We're talking about spending money on physical stuff.
Spending a lot of money on infrastructure. Data centers, GPUs, cooling systems, power grids, the whole 9 yards.
And the fear is what? That the money just vanishes.
The fear is that this money is vanishing into a hole and it won't pay off fast enough to justify the sheer scale of the spend.
We've got a report here from UBS that puts a number on this, and I honestly had to read it twice because it just didn't seem real.
I know the one you're talking about.
It says the hyperscalers, so Microsoft, Google, Meta, are spending nearly 100% of their operating cash flow on CapEx. Is that actually accurate?
It is, and it's unprecedented. Let's just break that down for everyone listening because it is the single most important number in tech right now.
Go for it.
Historically, over the last decade, these tech giants were absolute cash printing machines. They'd earn $1 in cash flow, and they'd spend maybe 40 cents of it on building things.
Okay, a 40% reinvestment rate. That's healthy, sounds normal.
Very healthy. And the other 60 cents, they just sat on it, they'd pay dividends, or, most importantly, they'd buy back their own shares.
Which supports the stock price.
That's the safety net, right?
It's the ultimate safety net. It artificially inflates the earnings per share. It puts a floor under the stock.
Yeah.
If the price drops, the company itself steps in and buys.
But now that safety net is gone.
Completely gone. They're taking nearly every single dollar that comes in the door and shoveling it directly into the furnace of AI infrastructure. 100%. That means there's literally no margin for error. If they have one bad quarter, they have no cash left over to smooth it out.
Zero. None. They are betting the entire farm. And this right here explains that Goldman Sachs data point we're looking at.
Which says share buybacks from big tech are down 7% year over year.
That is a huge signal. It's not a small dip.
It tells you they literally cannot afford to prop up their own stock prices. Why? Because they are so terrified of losing the AI arms race.
That's it, exactly. It's a classic prisoner's dilemma. If Google stops building, Microsoft wins. If Microsoft stops building, Meta wins. So they all have to spend maximum dollars, every penny, just to stay in the game.
But the market is looking at this massive, massive spend, and it's starting to ask, where's the profit? When does the check clear?
And that hesitation is showing up on the scoreboard plain as day.
Yeah. Let's look at the Magnificent Seven. For years, these stocks were the engine of the S&P 500. But year to date, in 2026,
they're lagging significantly.
NVIDIA is down 2%, Google is down 3%, Meta also down 3%, Microsoft is down almost 2%.
And you have to understand, in a normal year, a dip like that in those names would trigger a stampede of buyers.
Oh, absolutely. Buy the dip. That's the reflex we've all been trained on for a decade.
But State Street is reporting that they just aren't seeing it. The big institutions are not bottom fishing.
Why not? Is the party over for big tech?
It's not that the party is over, it's that the conviction has completely evaporated. I saw a note from Janus Henderson this morning that put it perfectly.
What did they say?
They said, AI accelerates so rapidly that we lack the conviction necessary to make the trade.
Wow. That's a fascinating thought. Usually speed creates FOMO, fear of missing out.
Right.
But now speed is creating a fear of making a mistake.
They're paralyzed. They are watching the fire burn before they decide if they want to cook dinner on it or just run away.
Because if you buy NVIDIA today and tomorrow, some new chip architecture makes their entire inventory obsolete.
You look like an idiot. So the big money is just sitting on its hands, waiting for some clarity.
Which brings us to the core strategy of this whole deep dive. Because chaos creates opportunity for people who know how to filter the noise.
Exactly.
Goldman Sachs has launched this strategy they're calling the pair trade. Now, I know we have listeners who aren't hedge fund managers. Can you just strip away the jargon?
Yeah.
What is a pair trade?
Think of it like a duel. In a normal investment, you bet on the whole market going up, right? You buy the S&P 500 and you hope for the best.
Right, you're betting on the tide.
In a pair trade, you isolate a specific battle happening inside one sector. You bet for one fighter, you go long, and at the same time you bet against the other fighter, you go short.
So you make money if your winner wins, but you also make money if your loser loses. It's a two-way bet.
Exactly. It hedges your overall market risk. If the whole market crashes, your short position makes money, which helps offset the loss on your long position.
So you're betting on relative performance, not absolute.
That's the key. And Goldman is applying this exact logic to the software sector. They're saying the entire sector is splitting into two distinct camps based on one single question. Can AI do your job?
Okay, let's audit these camps. This is the real meat of this discussion. Camp A, the long bet, the winners. Goldman is calling these AI resistant. Who are they and what makes them so safe?
These are companies that possess what I like to call a moat of reality.
A moat of reality, I like that.
They solve problems that require physical execution, deep regulatory compliance, or, crucially, human liability.
Okay, give us the names. Who's on this list?
The list includes the obvious giants like Microsoft and Oracle, but the
Hmm.
really interesting ones for me are the cybersecurity firms.
Like who?
Cloudflare, CrowdStrike, Palo Alto Network.
Okay, let me play devil's advocate for a second.
Yeah.
Why is a company like CrowdStrike AI resistant? Can't an AI write code? Can't an AI hunt for viruses on a network? Why do I still need a company for that?
Sure, an AI can write code, it can probably find vulnerabilities, but let's walk through a scenario. You're a major bank, you suffer a massive data breach, millions of dollars are lost. Who do you sue?
Ah, I see. You can't sue a large language model.
You can't sue an algorithm. You need a throat to choke, as they say. You need a legal contract with a regulated corporate entity that guarantees specific security protocols. That is the moat.
So it's not just about the technology.
No, it's about the liability shield.
Hmm.
Cybersecurity isn't just about stopping hackers anymore. It's about insurance and compliance and legal frameworks. An AI cannot replace the legal responsibility of a vendor.
That's a crucial distinction. The liability mode. If something breaks, a human organization has to be held accountable.
And then you have the physical moat. Take a company like Cloudflare. They literally manage the plumbing of the internet. They stop DDoS attacks. They route traffic.
Right, they're everywhere.
And that requires servers in 300 different cities. It requires physical hardware plugged into actual power plants. An AI that just lives in a data center somewhere cannot replicate a physical, globally distributed network of edge servers.
So the rule of thumb is, if the business involves atoms or lawyers, it's probably safer.
As a general rule, yes. And that's also why Microsoft and Oracle fall in this camp. They're so deeply embedded in the corporate infrastructure that ripping them out would be like performing open heart surgery.
Right.
They are the foundation.
The concrete slab the entire house is built on.
You got it.
Okay, so that's the safety zone, the long bet. Now let's look at the danger zone, Camp B. The short bet, the AI exposed.
Right. So Goldman is targeting companies that are focused on what they call workflow software.
Define workflow in this context because, everything kind of feels like a workflow.
That's fair. In this specific sense, it means moving data from point A to point B. It's filling out forms, logging help desk tickets, organizing files, basically the digital equivalent of paper pushing.
And the names on the hit list.
This is where it gets interesting. Salesforce, DocuSign, Duolingo, and even consulting firms like Accenture.
Whoa, hold on. Salesforce, that's a titan. That company is the definition of enterprise software. Why on earth is Goldman betting against Mark Benioff?
Think about what a sales rep actually does inside the Salesforce platform. They log a call, they update a lead from warm to hot, they schedule a follow-up task, they type out notes from the meeting.
It's all highly structured text manipulation.
Which is the one thing LLMs are absolutely perfect at right now.
Yeah.
So if you have an AI agent that can listen in on the sales call, automatically update the database, draft the follow-up email, and schedule the next meeting, why are you paying $300 a month for a seat license for a human to sit there and click buttons in a dashboard?
The interface itself becomes friction.
The interface becomes obsolete. If the AI does the work behind the scenes, you don't need the fancy dashboard. You just need the database itself.
So the argument is that Salesforce is essentially a very, very expensive interface built on top of a database.
That's the bet. Goldman is betting that as these agents rise, the value of that interface collapses towards zero.
And what about Duolingo? My kids love the owl. It feels like such a staple.
The owl is in deep trouble. Duolingo's entire business is selling language learning.
Right.
But we are months, maybe a year, away from seamless, real-time in-ear translation. If I can put in my AirPods and understand spoken French perfectly.
Then learning French moves from a necessity for travel or business to just a hobby.
And utilities are sticky. Hobbies are extremely churn-prone. That is a brutal economic reality for them.
The DocuSign.
Verifying documents. An AI can read and verify documents faster and more accurately than any human ever could. The entire workflow of emailing a PDF around to get a signature is it's archaic. An AI ledger can handle that instantly and more securely.
So the core thesis here is, if the software you sell helps a human do a digital chore, and the AI comes along and removes the chore entirely, the software dies.
That is the scare trade in a nutshell. We are selling better, more efficient typewriters right at the exact moment the word processor is being launched.
Which leads us directly to a piece of news that broke this morning, and it really feels like the nail in the coffin for some of these workflow companies.
I think so too.
While the U.S. markets are closed, the talent war is just escalating. OpenAI just made a hire that has all the Silicon Valley buzzing.
Peter Steinberg.
The creator of OpenCloud. So why does this one specific hire matter so much? Is this just inside baseball?
No, this is a major signal flare for everyone. Steinberg isn't a chatbot guy. He's an agent guy.
Okay, we need to distinguish those terms because they get used interchangeably all the time.
They do, and they shouldn't. A chatbot talks to you. ChatGPT is a chatbot. It gives you information. An agent does things for you. It executes tasks. It clicks the buttons. It browses the web. It fills out the forms.
So Steinberg moving to OpenAI means their focus is shifting from thinking to doing.
Aggressively shifting, and that just reinforces the threat to Salesforce and Accenture. If OpenAI successfully builds a universal agent that can use any piece of software on your behalf.
Then why would you ever need specialized software? The agent becomes the new operating system.
Exactly. It's a fascinating and, frankly, a terrifying evolution.
But let's zoom out for a second. We've been talking about software and stocks, but the physical reality of this AI build-out is playing out thousands of miles away from Wall Street. Today, the center of gravity is in India.
Absolutely. The AI Impact Summit kicked off today in New Delhi, and Prime Minister Modi is putting on an absolute masterclass in geopolitics.
So who's in the room? Who made the trip?
It's basically the Avengers of AI. You've got Sam Altman from OpenAI, you've got Dario Amodei from Anthropic, Demis Hassabis from Google DeepMind, Sundar Pichai is there.
But there is one very notable person missing. The man in the leather jacket.
Jensen Huang, the CEO of NVIDIA, is not there. The official line is prior commitments. But his absence is almost as loud as his presence would be.
Why is that? Do you think it's a snub?
I don't think it's a snub necessarily, but it highlights a really important shift. Modi isn't just there asking for software partnerships. He's pitching India as the new engine room of the entire AI world.
What's a pitch?
His message is simple. The West is running out of power. The West is drowning in regulation. Come to India. We have the land, we have the solar capacity, and we have data sovereignty.
That is a very smart pivot. For years, the whole narrative was just U.S. versus China. India is stepping up as the neutral third vector.
And notice who's there. It's the software geniuses, Altman, Amodei. They're there because they are desperate for infrastructure. They're realizing that their growth is capped by physics, by electricity, and by cooling.
Right? They can't just keep building data centers in Virginia and California forever.
They need global diversification. They need a new place to plug in all the machines.
So you've got the software war playing out in the stock market, you've got the infrastructure war playing out in India, and then you have the wild card, the man who seems to exist in his own separate orbit.
Elon Musk. You can't do a deep dive on 2026 without talking about the Musk factor.
He's fighting a war on two fronts right now. Let's start with the AI front. Grok.
You know, Grok started out almost as a joke, the edgy AI, the anti-woke AI. But the data that's coming in suggests it's gaining real sticky market share.
Why do you think that is? Is it technically better?
It's fresher. It has real-time access to the X, formerly Twitter, fire hose. So while ChatGPT can be very polite and sometimes a little sterile.
Grok is raw and immediate.
Exactly. And there is a massive market segment out there that wants what they perceive as truth over safety, and Musk is cornering that market. It's the fire horse of LLMs. It's chaotic, but it's incredibly fast.
But the bigger financial story with him is SpaceX. The IPO is finally on the calendar, June 29, 2026.
The most anticipated IPO of the decade, probably. But there's a catch.
Of course there is. There's always a catch.
The reports surfacing now say Musk is pushing hard for a dual-class share structure.
Okay, translate that for us. Why should the average investor care about different share classes?
It's basically a way to take public money without giving up public control. Class A shares for you and me, we get a piece of the profit. Class B shares, just for Musk and his inner circle, they get all the votes. It ensures that no matter how much of the company he sells to the public, he remains the dictator.
He wants the capital, but he absolutely refuses to let anyone else grab the steering wheel.
And can you blame him? I mean, look what happened at OpenAI with the coup against Sam Altman. Look at any corporate coup in history. Musk is basically saying, you are betting on the jockey, not just the horse. If you want my performance, you have to play by my rules.
And maybe in the year of the fire horse, people are willing to make that trade. They want the volatility if it comes with that kind of upside.
Contrast that with the old media giants.
Yeah.
While Musk is literally planning Mars colonies, you've got Warner Bros. Discovery and Paramount back at the negotiating table, just trying to figure out how to survive.
I thought that merger was completely dead.
It's a zombie deal. It just keeps coming back to life. Warner is apparently looking at a revised offer for Paramount because they're staring down the barrel of a $2.8 billion breakup fee related to the Netflix deal context.
It really feels like two dinosaurs huddled together for warmth while the meteor is streaking across the sky.
That's a bit harsh, but it's not inaccurate. It just highlights the difference in scale we're talking about. We just talked about Microsoft spending tens of billions on CapEx like it's pocket change.
Right.
And these legacy media companies are fighting for their lives over 2 or 3 billion. It's just a different universe.
It shows that if you don't own the tech stack, you're just a content library.
Ah,
And libraries get bought, they don't rule the world.
that's it. Content is king, but distribution is King Kong. And right now, tech owns all the distribution.
Let's pivot back to the global map again. We mentioned India, but Europe had a very loud weekend. The Munich Security Conference was tense.
Tense is a very polite word for it. Marco Rubio was there. Remember, he's Secretary of State in this administration. And he essentially walked into the room and told Europe to grow up.
He called for a cultural revolution in Europe.
He did. He said Europe needs to stop regulating and start innovating. He said America wants an ally, not a vassal.
That is a stinging rebuke. Don't be our dependent, be our partner.
And Ursula von der Leyen from the EU immediately fired back. She drew what she called red lines on digital sovereignty and freedom of speech.
And that's the core friction point, isn't it?
It is. The U.S. model is move fast, break things, and dominate. The European model is regulate first, protect privacy, and ensure fairness. Rubio is basically saying your fairness is making you economically irrelevant.
But on the financial side, the ECB is actually doing something pretty interesting to protect that stability.
Yes, Christine Lagarde is launching a new liquidity strategy. It basically allows banks to borrow cash against their high-quality bonds so they aren't forced to sell those bonds during a market panic.
It's a fire extinguisher.
It's a pre-positioned fire extinguisher. They know volatility is coming. They're getting the safety nets in place so the entire banking system doesn't seize up the next time the U.S. or China sneezes.
Well, speaking of China, they're entering the year of the fire horse. How is the dragon doing?
You know, it's doing better than the headlines would suggest. All we hear about is the property crisis, the demographic collapse.
Yeah.
But you have to look at the scoreboard. Chinese tech and AI stocks closed the year of the snake up double digits, anywhere from 14% to 23%.
So even while the broader economy struggles, the tech sector is decoupling and moving up.
It's incredibly resilient. They are not sitting out this AI race. They're finding ways around the chip bans. They are innovating at a furious pace.
And what about Japan?
Japan is struggling a bit more. Their latest GDP data just came out and they missed expectations. Only 0.1% growth.
It's practically flat.
It is. They just managed to avoid a technical recession, but there's no momentum there at all. And the big worry for them is exports.
Because of the potential for new U.S. tariffs.
Exactly. With the Trump administration, an export-dependent economy like Japan is right in the crosshairs.
Okay, so we've covered the pair trade, the capex fears, the whole geopolitical chessboard. Let's talk about where people hide. When the world feels this crazy, where does the money actually go? Let's look at the alternative hedges. Let's start with Bitcoin.
Bitcoin is sitting there at around $68,000. On the surface, it looks pretty boring, just chopping sideways.
But under the hood,
Under the hood, the plumbing is starting to leak. We're seeing significant ETF outflows. About $2.8 billion has left the crypto ETFs in the last 3 months. But the real signal, the one to watch, is the institutional short.
the big banks are betting against it.
They're hedging. The retail investors, the hocho dealers are refusing to sell. They're holding on for dear life. But the smart money is quietly building massive short positions using the futures market. They're expecting a flush.
That is a classic divergence, isn't it? The believers versus the bankers. Who usually wins that fight?
In the short term, the bankers have more firepower, but, Bitcoin has a habit of surprising everyone. And oil.
Oil is caught in this massive tug of war. On one hand, you have supply increasing. OPEC Plus is set to turn the taps back on in April. That should push prices down. But on the other hand, you have U.S. aircraft carriers moving around in the Middle East. That creates geopolitical tension, which pushes prices up.
So it's supply versus fear.
Exactly. It's a coiled spring, ready to pop one way or the other.
Okay, we have covered a massive amount of ground here. Let's try bring this all in for a landing. We promised the listener a strategy, a way to navigate this fire horse.
And the key takeaway, I think, is that passive observation is dangerous right now.
So you can't just buy the S&P 500 index fund and go to sleep for a year.
I wouldn't, no. Because the index is so heavily weighted toward those big companies that are currently hesitating. That Mag 7 drag we talked about is real. You need to be active. You need to rotate.
All right, let's recap the checklist then. The fire horse protocol. Number 1, the moat check. Go through your portfolio stock by stock, and for each one, ask, does this company have a real physical or legal barrier to entry? If it's just a piece of software that organizes data, you should be afraid. Very afraid.
Okay. Number 2, follow the CapEx.
Right. Watch the cash flow statements. If a company is spending 100% of its cash flow on chips and data centers, they are flying without a parachute. That is a high-risk hold. You want to find companies that are investing, yes, but still have cash left over to buy back stock if things get ugly.
And finally, number 3, watch the agents.
This is the longer-term play, but it's the most important one. That Peter Steinberg hire at OpenAI is the signal. We're moving from a world of chat to a world of action. And if you own stocks that rely on a human being clicking a button in a browser, you are holding a melting ice cube.
I want to leave the listener with a final thought on that very point. We talked about software, using software.
The ultimate disruption, right?
We spend billions, maybe trillions of dollars on user experience, UX design, making buttons pretty, making apps sticky.
The whole engagement economy.
Right. But if my AI agent books my flight for me, it doesn't care if the airline's website is pretty or easy to use. It just hits the API in the background.
It bypasses the ads. It bypasses the branding. It bypasses all of it.
So in a world run by agents, does the value of the user interface drop to zero? And if it does, how many of the apps on your phone right now are just fancy interfaces waiting to die?
That is the question that keeps a lot of venture capitalists awake at night.
Something to mull over as you watch the Lunar New Year fireworks.
Indeed.
We will be watching that India summit very closely this week. If there's a major partnership announcement, if OpenAI partners with an Indian energy giant, for example, that is the signal to pay attention to.
Absolutely. We'll be tracking it.
Thanks for listening to The Deep Dive. Stay curious, stay skeptical, and watch out for the fire horse. We'll see you next time.